Hi, I'm James Robinson. I manage money for a living. My company is Robinson Stocks, and this is my stock thought of the week. This is part 2 in my 5-part series on the company Lazyboy, symbol LZB. Today we're going to look at the company's operations, which is really a look at the efficiency with which the company delivers goods and services to the customers. If you look below in the comments, you'll find a link to all 5 videos in this series once I've got them all published. The first place I do any research on a company is by looking at the company's gross margins. And I know that might seem counterintuitive if you haven't really thought it through, but I think gross margins are a really good way to figure out if a company has a consumer monopoly or is a cyclical company, is a commodity company, because gross margins will behave differently and will appear in different ways depending on the type of company it is. For example, if a company is a commodity-driven business, then typically gross margins will gyrate as the value of that commodity increases relative to the cost to produce it. Whereas a company that is a consumer monopoly will typically have a very straight line, very stable amount of gross margins. Obviously, the higher gross margins are, the more pricing power a company has, which is a sign of a consumer monopoly. And the lower the gross margins are, the more likely you are to have a commodity product. You can also figure out if your company's competitive advantage is declining by looking at gross margins and seeing them go the wrong way, or you can see perhaps the company's competitive advantage increasing if the company indeed has, if the gross margins are going up over time. So here we see the gross margin for the company Lazyboy, and what's really interesting is if you look at Lazyboy's gross margins from 2002 really until 2020, you're going to see that the gross margins have gone up really pretty dramatically over that period of time. It's gone up gradually every year, but in the aggregate, it's gone up quite a bit, and it's gone up in a straight line. And that tells me this company is building its brand year after year after year, because they're able to charge a little bit more for their product every year. Probably means they're improving quality at the same time, because customers are coming back time and time again. You know, we know that a Lazyboy, which is a chair, which is a piece of furniture, isn't something you buy every year. It's something you buy every 5 or 10 or 15 years. And so for them to be able to grow their gross margins means that they're producing, I think it means they're producing a really good quality product, and that people are just deciding they'll come back and they'll pay the little bit extra to get the Lazyboy because they know they're getting a really good product. So that's what you can really see with gross margins for this company. Again, any company with a gross margins of over 40%, that's a company I'm very interested in. This company's been above that level for the last 6 or 7 years. So we're really, really excited about this company based on its gross margins. The next thing we're going to look at is earnings per share for this company, and a couple of stories that I want to tell you here. First of all, you see we look at both earnings and we look at earnings per share. I do that because oftentimes a company is buying back stock, and in the event of buying back stock, the earnings per share will go up faster than the earnings. I want to make sure that that's happening if I can. But again, I want to see that for sure that the earnings in the company are going up over time. And what's fascinating about this is that the earnings from 2018 have gone up pretty dramatically. And what's really fascinating is that the company's stock price has dropped about a third in the last 12 months. And while that's happening, the earnings have gone up. This company's now trading at 6 times earnings, which is ridiculously low for this company. And it's really the reason I think you should buy it. At 6 times earnings, this company is a real steal. You can see again, the earnings per share haven't gone up much more dramatically than the earnings in general, which tells you this company's probably not buying back stock. I'm not happy with that, but we'll talk more about that when we get into the wealth creation sections of the videos. The next things we're looking at is net earnings as a percentage of revenue. What we're really seeing here is for every dollar the company makes in sales, how much of that dollar becomes profits. We want to know what's happening on that. You can see that it's basically been a dead straight line since 2012. So that's fine. It's gone up a little bit in the last 4 or 5 years, but nothing to write home about. It's sort of in the middle of a pack of companies. Not great, not bad. There's other things about this company that are compelling beyond this. The nice thing is that while the net earnings percentage of revenue has been flat, the revenue themselves has gone up, and in fact gone up pretty dramatically in the last few years, which has allowed the earnings to increase over time as well. So this company isn't going to, triple its earnings in any given year. It's not going to do anything major like that, but it's going to make you money every year, and it's going to grow over time. And as we'll see in later videos, it doesn't take a lot of retained earnings to make money. So this is a solid company that we're buying at a fantastic price. rather than a great company we're buying at a fair price. And so maybe it's a cigar butt investment more than it's a compounder, for example, but we can still make money on stocks like this. You know, Ben Graham made a whole career doing that. So I talk about all the time the 4 taxes that a company has to pay once they paid the cost of goods sold. So these are things that, you know, the revenue is how much money you make. Subtract out the cost of goods sold, you get your gross profit. From your gross profit, you have to subtract these kind of costs to run your business. And what's left is your operating costs. And so sort of the 4 major one of those taxes are selling and general administrative, plants and equipment, research and development, and inventory. And I like to look at what's happening with all of these, because if a company has, for example, a tremendous amount of research and development, that tells me something about the kind of company it is, and it also tells me that whatever advantage they have is only an advantage to the fact that their research and development continues to be fruitful. If a company has a ton of inventory, then they can only make money as long as that inventory is able to be turned over. And if that inventory shouldn't be turned over, it gets catastrophic to profit. So we look at all of these things and we're looking for red flags or for good signs. Selling and general administrative for this company is very, very high. It's in the bottom 25% of companies. I don't like that. It also isn't getting any better, but it also isn't getting any worse. So the profits for the company have gone up over time, even in the last few years, even with this really high selling and general administrative cost. Now, part of that might be that this company has company showrooms, and those company showrooms are expensive to run. They're not, they generate profits, and so you don't mind having them, but they just are expensive to run. Might be that the company is inefficient in terms of the way they manage their selling and general administrative costs. But again, no company is perfect. Every company has some weakness. And the idea is to identify it and keep an eye on it and say, wait a minute, not only is it bad, but it's getting worse, or it's so bad it's hurting the company. And in this case, it's bad, but it's been constant for 8 or 10 years. And so I just have to say we can live with it because we're buying this company at such a great price, and the earnings have been managing to go up despite this. The next thing we look at is plants and equipment. Again, plants and equipment have been higher they were okay for a number of years, but the last 3 or 4 years, they've gone up pretty dramatically. That's because this company has been trying to increase their production capabilities, and they've been doing that because they've had an increase in sales. So I'm not necessarily horrified at this. My hope is that as the sales, as the plants and equipment go up and the profits go up, these numbers will get more in control. But again, it's not the end of the world. One of the things you have to know about Lazyboy is that it's a manufacturer. And so it's going to have a very high plant and equipment cost. And that's just sort of what you have to accept when you're buying manufacturers. Again, we're buying this company very, very cheap in terms of earnings. And one of the reasons we're buying it very cheap is because it's not perfect. It's not, it's not Alphabet of 3 years ago where everything about the fundamentals was so great, you just knew it was going to make money, and so you bought it. So we just have to be aware of that as we're looking at these companies. The next tax is inventory and then research and development. So I'm fascinated that the inventory cost is so high here. What we're seeing is that the inventory is, in the bottom, close to the bottom 25% of companies. Part of that is because a lot of companies don't have a lot of inventory. In this case, I think it's that this company has a whole bunch of showrooms, and they have to keep all their furniture in stock in the showroom so people can go and buy it. But what I can tell you from my own research, because I was looking at doing a home theater room in my house, is that you can't buy any furniture at Lazyboy. If you want to have something, it's going to take 6 months to a year to get it delivered. So they have this sort of ability to deliver furniture 6 months from now, but in the meantime, they have to have a whole bunch of inventory, which is really just for show. And I think that that's the issue and the cost here. The good news about the inventory for a company like Lazyboy is that it doesn't tend to go bad, right? Like, it's not like they're selling bananas and in a week from now, the bananas will turn brown and you have to throw them away. This furniture can stay in the shop for a year or two and still be completely perfect and functional, and these can still sell it and do okay with it. So inventories aren't as bad for this company as they are a company that is either high tech and the product will become obsolete, or it's got a perishability to it. So we're a little bit okay with having higher inventory costs. The R&D for costs for this company are zero. Obviously, that's great. Don't need to really worry about that too much. And so let's move on to the next slide. The fifth tax is what we call, is interest payments. The fifth tax is interest payments. And this is different from the other four because it's a self-inflicted tax and you don't necessarily have to have it. If you think about it, most companies either do or don't need inventory, but if they need inventory, they need a certain amount. They either do or don't need R&D, but if they need it, they need a certain amount. No company has to have interest costs. In theory, any company could pay down their debt to zero and maybe should, and if they did, they wouldn't have to pay any interest. On the other hand, some companies voluntarily take on tremendous amounts of debt to the point where when things go south, it can jeopardize the whole company. So in this case, you look at this company, I like to have about 15, I don't like to have more than 15% of my operating income going to interest expense. And you can see this company's never even approached that. It's never really been even at 8%. And right now it's 2 or 3%. So it's really de minimis. It's not very much worth talking about. The other thing is that even though as the income has gone up over time, it appears the debt level stayed pretty basic, pretty standard, pretty stable, and the interest expense therefore as a percent of operating costs have actually gone down. So we're not going to worry about interest payments for Lazyboy. So in summary, the gross margins for this company are perfectly acceptable. More importantly, they've been growing over time, which I think means this company is acquiring a moat. They're making it stronger every year. Really, really excited about that. That's a good thing for this company. The earnings per share have been going up pretty dramatically since 2012. They've really doubled since 2012, and really they've actually doubled since 2018. That's fantastic. Earnings per share gone up pretty much in lockstep with the earnings, so not a lot of stocks being bought back. The net earnings as a percentage of revenue have been very stable. The revenues have been going up, however, which means the earnings are going to go up because we've had the same amount of profit derived from revenue and the revenue is increasing. The selling and general administrative is much higher than I'd like, but it's stable. Plants and equipment is actually going up. But again, we've seen an increase in revenue, pretty dramatic increase in profits over the last few years. So that's to be expected. There's no R&D. Inventory for this company is very, very stable. And we've talked about the fact that the inventory is neither perishable nor likely to be subject to obsolescence. So we're not as worried about it. The company doesn't really pay any interest costs. So long story short, the operation of this company pretty good, especially for a manufacturer, and very, very good considering you're buying the company at 6.5 times earnings.